Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Okay, everybody, back for Jim Carroll Part 2. This is going to be episode 118. We got Jim Carroll back with us for Part 2. And Jim, this one's going to be how to retire with tax-free income, not just 100% of your income, but completely tax-free income, right?
Yeah, that's right. It's Part 2 of the trilogy. It seems like it's been way too long, but things have been happening all over the place, and so I'm excited to go at it one more time.
Yeah, you had deaths in the family and car crashes and all kinds of stuff. I'm sorry you went through that, and sorry for the listeners that you had to wait so long, but you're back at it, and we're ready to rock.
Ready to roll.
So this is no shock to me because I came into the industry in 2005, so 14 years ago as we record this. I came in because of this tax-free income idea, and like, that doesn't sound right, and found that it was not only right, it's been around for 30, 40 years. Most people, I would imagine, are going to hear this and say that just sounds too good to be true. Is that your experience?
It is, and it's the old thing. You always do what your parents did, and they always do what their parents did. And so when something sounds new and it sounds too good to be true, they tend to be skeptical. And so part of this is making sure you're with the right advisor and the right company that backs up the history there and documents everything so that it's not too good to be true. It's actually very factual.
And this is, you and I know this, but this isn't new. It'd probably be more accurate to say this is a very old strategy, but it was really heavily utilized by the wealthy and to some degree kept a secret for a while. This is more new to the mainstream or new to the regular folks, right?
And that's it. It was widely used by Congress and people that were extremely well off. But insurance companies have been able to do this down to just middle income America. And, the number one goal for everyone we talked about in the first was how to retire with 100% of your income. If you make $75,000, $85,000 on Friday, you still need to make $75,000 to $85,000 on Monday. You just don't need to go to work anymore. And the only way to do that is through proper planning.
Yeah.
The second thing I would tell you is, there's three ways you're going to get your money when you retire: taxable, tax deferred, and tax free. How would you like to receive your money when you retire? I think the number one answer is tax free, but then they look at you with that kind of crooked head look and say, but how do I do that?
Right. And there's different ways to do it, right? I know of three, but they have totally different characteristics, and some of them you're not going to be able to put in enough money to even generate the nest egg or the income you want.
Well, that's it. And there's certain things that have happened just this year that make it even more advantageous. What happened to everybody's paycheck in February? Went up, right?
Yeah.
You're thinking, well, I don't remember seeing it go up. Well, what happened is if you're a family of four, husband and wife, two children, make $150,000, you're going to take home $3,000 more per year with the tax reduction. And people don't realize it because if they get paid 24 times a year or 12 times a year, it's just a little bit more in every check. But that's still $3,000 more take-home pay every single year.
Yeah.
But the other thing Congress did was when they put that in, they put a huge asterisk, and they said in 2025, through the sunset law, taxes will go back up to exactly where they were. So, Charlie, my question to you and to the listeners is, 8 years ago, we were $10 trillion with a T, $10 trillion in debt. Now, 8 years fast forward, right now, we're $20 trillion in debt. So if we doubled in 8 years, what are we going to be at in 2025? Do you think we'll still be at 20 trillion, or do you think we will be at maybe 30, 40 trillion dollars?
Yeah, we've got a scary trajectory of debt, and then we're looking back at times in history where, what was it, when Reagan was doing movies where the marginal tax bracket was 94%, right?
Oh, yeah.
And just saying, well, if it happened before when the country wasn't in debt, and David Walker quit his job and is traveling around the country saying taxes have to double, and David McKnight's making movies, for heaven's sakes, right? If that's all happening, I mean, isn't it possible, just to be very conservative, isn't it possible that it happened again in the future, that taxes would go up since the country's in much, much worse trouble?
Well, we know they're going to go back to where they were. That's a given. That's
right.
The sunset law. But if there's only two things that we can do to lower taxes: get Congress to spend less. We can't even get them to talk to each other across the aisle. So I don't know that that's going to happen. Or tax more. And so if we're going to tax more, we're in the lowest tax bracket right now. And so the whole idea is to pay tax on the seed and not the harvest.
Right.
If you can find a vehicle that you can pay tax on right now and never pay tax on it again, I think it's the greatest time in the history of the United States, for sure in our lifetimes, to save towards retirement.
Taxes are kind of on sale until 2025, right?
There's a discount.
So it's the time for Roth conversions, or for, getting money in your paycheck and paying the taxes now instead of putting into 401ks and IRAs, and then put it somewhere like we'll talk about, one of these three places where you'll never be taxed on it again. Here's the nice thing. If you gamble and say, I'll pay my taxes in retirement, it could go well or it could go poorly, right? The taxes could go down, which I've never heard anybody say they think that's going to happen, but then you win, taxes go up, you lose. If you go the other route and you're conservative and you say, I just don't want to pay taxes in retirement no matter what happens, it doesn't really matter if taxes go down, stay the same, or go up. You have the same thing. You just keep every dollar of your paycheck.
That's right.
You set yourself up to win no matter what happens.
Well, I think that's the key, is if you had started work, let's say you're an employee, you're going to work 30 years, you can be aggressive, moderate, conservative. But 30 years from now, somebody said, I'm not going to put anything into your account, but I'm going to hold a checkbook and I'm going to take out the first percentage and you get what's left over. You'd say, that's just no way. That sounds like The Sopranos, right?
Yeah.
Well, no, that's our tax system. We don't know what taxes are going to be. It could be as high as, it was when Jimmy Carter and Reagan were president, or it could be as low as it is right now. What I don't want to do is bet on the chance that the debt's going to be high and taxes are going to follow. And I know from now to 2025, we absolutely have a set tax bracket that I want to take advantage of.
Smart. Exactly. It might have been you. Was it you that said that having an IRA or 401k or any of these, sort of qualified plans where you're paying tax on your income is like having a business partner in the IRS and they vote every year on how much of the profits they get?
Right. They have the ultimate vote.
They
the
just
only
control it. Yeah, they have the only vote. We didn't even get one, right?
That's right.
So
what's left over.
My listeners are used to this. I'm a contrarian. I'm not out there saying, pay off your house, postpone taxes to a later date, and put it all in securities, just spread it around, because they're not supposed to go down at once. I call those the three pillars of financial deception, and sort of disagree with all of them when I went and studied them. So this isn't going to be new that I'm sort of on a different side than the brokerage houses. But what are the three places to put this money to grow tax free, and should people be splitting it up equally among all three? Or tell me your thoughts on that.
Well, and it all goes to personality and ability. I mean, probably the most widely known is the Roth. The Roth has some great features to it. Two of the drawbacks are, if you make too much money, you can't contribute. And the maximum you can contribute is $5,500 if you're below 50. If you're over 50, $6,500 this year. So there's some real limitations. Just like you can't, if you're someone that's making $300,000, $250 or more, there's no way you can retire on putting $18,500 a year into a 401k. It's just not going to happen.
Right.
There's not enough leverage there, even with the miracle of compounded interest and a perfect market, to get you to that spot. So we know $5,500 or $6,500 is not going to be enough either. So while that's a great plan, it doesn't help someone that's above those income limits. And so, there's always bonds, municipal bonds, and municipal bonds are great, but they're limited also. And there's fees and there's things that happen there. And I'm not sure your feeling on that, but I don't think you should have all your eggs in one basket. The last one is cash value and an insurance policy. And it's funny because I flew home. I was in training all last week. Fortunately, I got bumped up my daughter's last high school game to cheer in the playoffs. And so I'm trying to catch a flight back. I got bumped up to first class. Inevitably, I sat next to a guy that's fairly talkative. I was a little tired, long week. And the number one question that comes up, it's because how we size people up in America, is, hey, what do you do for a living?
Right.
Well, I thought about it for a minute. I said, I'm a little tired. If I wanted to take a nap, all I have to do is tell him I sell life insurance or work for the IRS.
That's right. It's our secret weapon.
That's it. He'll never say another word. I mean, he's leaning the other way.
Exactly.
This guy had a Rolex watch on, a nice pair of custom boots, and he had a business right down the road from my office. And so I came at him a different way. I said, I help people retire tax-free. 1001, 1002, 1003. How do you do that? And as a business owner, that's the perfect opportunity. If I told you, hey, I'm going to show you how to retire tax-free using life insurance, the first thing everybody does is shut off your podcast.
Yeah.
But it is a great way to do it. And it's one of the 3 ways that I know to retire successfully, but it also covers some of the other things. When I look at it, I draw a line right down the middle, and it's your income line. It's from the start of your career to the end of your career. And we don't know when the end of your career is. I mean, people are working longer. Life expectancies are longer. Females at 77, males at 75. I mean, the guys are catching up. We're taking better care of ourselves, modern medicine, the whole deal. And so I'm hoping I'm going to outlive that actuarial curve. I want to be past 75. So the things I have to worry about as a business owner or as an individual is, first, if I die too soon. If I die too soon, what happens to my income power? My income that I provide for my family or for my business. So I have to have some type of death benefit. I'm 55, and so the second thing that you start worrying about, Charlie, you're not worried about this yet, but it's coming fast, is if I become ill.
Yep.
I mean, you see people that have a heart attack, a stroke, and don't die. What's the number one fear of somebody that has a stroke and didn't die? They have to go through rehab. And if they don't have disability, that income's either stopped or at least delayed for 6 months to a year.
Mm-hmm.
And so you need something to cover that. And then I guess the good news and the bad news, the catch-22 is what if I live too long? What if I live past that 75 to 85 or 95? That's a big deal. And so those are the 3 things as a planner I have to cover. If I don't, I'm being negligent. And I know that when you look at some of the older style policies, think about it like this. I'm going to give you an analogy, and it's the analogy of the TV. You remember the old TVs with the antennas up in the air and the aluminum foil?
Oh, yeah, the rabbit ears.
Yeah, rabbit ears. And then you had, the channel changer was click, 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 click.
Yeah.
I mean,
Channel
think about
changer was your kid. That was your remote. Hey, buddy, go change the channel.
I was that guy, right?
Yeah.
So think about it now. How many channels can you get on a TV? Many as you want to pay for.
Yeah, thousands.
I mean, we've got a satellite. And now you have, man, if you're a guy and you don't have at least a 65, 70-inch TV, you don't even invite people over to see it. You're a little embarrassed. But the greatest thing is they have these channel changers. My kids call them a remote, but mine changes the channel, so it's a channel changer. Mm-hmm. I can say, hey, I want to see, the University of Texas, Oklahoma football game. It tells me what it is and reserves that time and changes to that channel when it comes on. I don't have that yet, but that's definitely on my wish list.
This Christmas.
That's it. And so with old style policies, you either died and it went to the death benefit went to your beneficiary, or you lived and you had cash value that you can use. But with the new style, they have something called living benefits. If you become critically ill, chronically ill, or terminally ill, or critically injured, they'll accelerate the death benefit. So in that case, if someone has a stroke and needs 6 months to a year to go through rehab, they can actually pull $100,000 out of their $500,000 death benefit. As long as it's diagnosed by a doctor, they can actually use that money, completely get rehabilitated, go back to work. The only thing that it cost them was now instead of having $500,000 worth of death benefit, they have $400,000. They were able to use that death benefit while still living.
Right, and that's one of the reasons everybody hated life insurance during a certain time frame is it felt expensive, and you didn't benefit from it until you were dead, so you never really saw any benefits, right? It was just a sort of a gift of love to your family, right?
Yeah, you had the old gray-haired guy in a suit come in and sit there in front of you and your wife and say, well, you can either buy this life insurance or you can have your wife and children move into a smaller house, or she can get remarried and let somebody else raise your kids.
Yeah.
Yeah, that's a really good sell, right? That's not what you want. That's a fear tactic versus something that really covers. The other thing that's really good about this, what's the number one fear of every single person over 50 years old?
I would think either, like get sick or running out of money during retirement.
Going into a nursing home.
Yeah.
The average life expectancy of someone living in a nursing home is less than 36 months. What I'd really like is to have somebody come into my home. If I can't do 2 of the 6 acts of daily living, I want somebody, a licensed professional, a nurse, to come into my home and help me. If I get to a certain age, I want to go into one of these assisted living facilities. That's a country club because they have golf tee times set up every week. They have dominoes. You've got everything you can imagine, but you also have nurses and doctors that can come to your room or into the clinic right there on premises and take care of you.
Yeah.
With this, if you had $500,000, they can take 2% per month or 24% per year if you can't do 2 of the 6 acts of daily living, and pay for that just like you had long-term care. And it doesn't cost any more. It's just part of the policy.
And if I understand correctly, I don't do a lot of the traditional long-term care policies, but I've read them, and you can't bring somebody into your home. That was like going to a nursing home, period, for most of them, right?
Oh, yeah. And they're extremely expensive. Every 5 years they go up. So when you need it the most, it's the most expensive, and they normally lapse.
Mm-hmm.
There is no additional premium. It is part of the policy.
Yeah.
So those are the parts that nobody wants to talk about. The part that is exciting to talk about is the upside on that, is the fact that everything that goes in there goes into a cash accumulation account. A portion of it goes to pay for the death benefit and the living benefits. But if you do this and the miracle of compound interest takes in, you're going to have a cash accumulation account. And everything in that cash accumulation account can be used as income to a tax-free loan. And so the goal there is, as a planner, to make sure that we have upside potential, to make sure you can have the potential for double-digit returns. And my policy over the last 5 years has had double-digit returns all the way from 11 to 14% on my personal policy. But what do we want after a month like October?
Mm-hmm.
Downside protection. We want to make sure that we don't lose money and we don't have to regain what we lost. And that's what Equity Index Universal Life Policy has, is we use the S&P 500 or some type of an indice as an index to give you the ups but not the downs. That's why it works so successful.
Let me talk about this for a second, because when I've been doing this now for 14 years, and for the entire 14 years, been watching policies perform the way they're supposed to, and for the entire 14 years, listening to people like Susie Orman and Dave Ramsey badmouth cash value life insurance and say it's too expensive, it doesn't make any money, blah, blah, blah. Not all life insurance policies are created equal, and it was kind of the birth of this entire idea, this entire strategy, this entire industry. The birth of it really was the E.F. Hutton organization saying life insurance has great tax advantages, but crappy returns. Like, whole life is not the way to go. How do we fix this? Boom, the creation of universal life insurance. And then over the years, hone it. Other brains get involved, market changes, get to a place like today. You can buy life insurance that's fixed. You can buy it variable, meaning just the Wild West. You have the stock market, or you can buy what you're talking about, indexed. When the market goes down, you never lose a penny. When it goes up, you share in the earnings. I did a podcast and a video on my YouTube channel at watchcharlie.com. I did a video called 6 Ways to Improve Your Cash Value Life Insurance. If you pick the right company, the right product, the right death benefit design, the right death benefit amount, right? So whether it's level or increasing and then switch to level or whatever you're doing, right? And then you have the right policy loans, the right commission structure, right? There might be some term riders thrown in there. If you have everything set up properly, a life insurance policy, as you're saying, has been beating even the stock market returns. So when people hear us talking, we are not saying go down to, Snoopy and buy a life insurance policy, whatever they suggest at all. Especially don't tell them the death benefit. I want a $500,000, right? We're talking our style of working backwards. How much money do you have either in another policy to transfer, or how much money do you want to save, right? If somebody's not putting money in, somebody says, I think taxes are going to go up in the future. I'm not going to do $6,000 a year in an IRA. All right, pay the taxes on it. You have $4,000 left over every year. Where are we going to put it? Let's put it into a policy, right? And work backwards from the premium or the goal, and then solve for the best way to design it. We can't see it on a podcast, but it when designed properly, these things should be making 6 to 8% easy long term.
Well, and for a lot of them, they use a stress test as the Great Depression. How would it have worked during the Great Depression? And if it can make it through that, it can make it through where we're at. Now, what I love is people don't talk about where this goes back to. The buy term and invest the difference was an old A.L. Williams deal.
Mm-hmm.
And, everybody says buy term and invest the difference. Susie and Chuck and all these guys are on TV because that's really great. It's the simplest form. Well, what never happened? No one ever invested the difference.
Yeah, that's
Number one,
requires
because they
discipline.
didn't know how.
Mm-hmm.
And number two, they were a little bit afraid of the roller coaster ride. They weren't a sophisticated investor. They didn't have someone telling them what to do. So they just bought the term and didn't do anything else. And you and I know that 80% of all term policies never have a death benefit because they live beyond the term.
Mm-hmm.
It's a phenomenal product for life insurance companies, not so much for the consumer.
Yeah.
Whole life, man, I like Snoopy. And it's, there's all kind of neat things about it, but it's like putting your money in a savings account right now. I mean, you're earning ridiculous interest rates. Sure, it's a guarantee, but it's not got any upside potential.
Well, I have a whole life article on my Instagram account at charliespictures.com, and I did an episode on why I never use whole life. And I don't know if you know the story, but in the earlier part of my career, there was a guy that had 6,000 insurance agents at his marketing organization, right? And I ended up top 15, so I became friends with the owner and finally approached him. I said, Bill, like, I don't hate any tool. I know all these tools exist. A screwdriver's good for one thing, a hammer's good for another thing. When do you use whole life? Like, what problem does it solve that nothing else solves? And he said, I have to tell you, after 50 years of doing this, Charlie, I can't find a place where I'm comfortable using whole life because it tries to do a little of everything and does all of them poorly, right? It's trying to be cash accumulation plus death benefit, plus there's some guarantees built in, plus this. I have a third-party article that shows, a group that went and studied, 10, 20 insurance companies. What did they promise on the illustrations 20 years ago? And then what was the actual internal rate of return 20 years later? And it says as clear as day, the whole life companies tell you they make 6 or 7. When it comes to push comes to shove at the end of the year, they have to choose what dividends to share. They only give you 3 or 4. And that's another piece people really have to understand. To have your growth, yes, it's great that it's tax-free, but to have your growth tied to one company's performance and then whatever they choose to share, which is called a dividend, that's very subjective and it's not diversified at all. It's one company versus, let's say, an indexed universal life like we're talking about tied to the S&P 500, that's 500, the 500 top performing companies, and it can change so that it keeps the top companies in there. That's diversified, and it's also completely objective. The insurance company can't change their caps after they're set just because they want to keep more of the profits. It's objective and diversified where whole life is not.
Well, I think my greatest example is, when you look in the mirror, I work, and as your listeners know, I work for National Life Group, a 170-year-old company, A+ rated, fastest insurance company in the last, growing insurance company in the last 10 years. What do I own? And I own an equity index universal life. Why? Because it has the best potential. I could fine tune it. I could build exactly what I wanted for my family. And so there's no better example than, what do you own? I mean, what do you have in your portfolio, Charlie? I know what you have. I mean, you buy what's going to be best for you, and then you emulate that with your clients.
Right.
And it's, again, it's if your fillets were on sale down the street at a $1 a plate, you'd first go get you one, and then you'd call all your friends and tell them about it, right?
Right.
We got a deal on fillets. Well, it's the same thing here. I don't have to die to use this. All the things that I'm afraid could happen are covered on this policy, but it also solves for one of my number one issues is that when I retire, I want to have 100% of my income. Oh, and by the way, I want it as tax-free as possible. I know if I have a pension, that's taxable.
Yep.
I know that if I have a 401k, 403b, 457, I'm going to put as much as I can into that policy up to the match. And then I'm going to stop. Everybody says, well, why stop? Well, because now you're putting money into this tax time bomb. You don't know what the tax rate is going to be when you pull it out. I'm going to take the free money, but everything over that match, I want to put into a tax-free policy. And the reason why is I can pay tax on the seed today and never pay tax on the harvest.
Exactly.
And that's my philosophy. That's what I believe in. That's what I do.
Exactly. Hey, let me read you a sentence. Okay, this is a quote that I have at the bottom of all my emails, so you may have seen it, but I'll read you a sentence, have you interact with it, and then we can get to the tax-free income and exactly why that's even allowed, why doesn't Congress take it away, all that stuff, right?
Right.
So it says, and by the way, I'm 46 and have $0 in securities at all. I have a securities license. I carry a Series 65, setting up my own RIA right now. Need to be able to give the best advice and offer everything people might want, right?
Right.
For me, I'm 46. I don't have anything in the stock market, and it's not because there isn't upside potential. It's because these other tools do it better, and they cover me in more possibilities. Like stock market's great for growth, and that's about it. What about it's not growing up? You know what I mean?
Right.
So here's my quote: a comprehensive financial plan will take care of you and your family, whether you have a long life, short life, rough life, sick life, and when you finally move into the next life.
And that pretty much covers it all. I mean,
that covers it, right?
And we did not coordinate this. What I was saying on the die too soon, become ill, live too long.
Exactly. That's what brought that quote up to
income.
me. I mean, we call that the 5 lives of retirement test. So why don't I have a stock portfolio if that's what 46-year-olds do? Because supposedly we have time to weather the ups and downs. It's because I don't care about the ups and downs. It just fails all of my tests. If I have a long life, I live a long time and need income, right? Or inflation goes up. A portfolio of stocks, bonds, and mutual funds does not do income well. It just doesn't. There's reverse dollar cost averaging, and you're taking money out when it's down. It's just not a good income tool, period. Short life. What if I die? Does it get bigger and take care of the spouse I leave behind and give them all the income they need? No, 100% it doesn't. Stocks just stay exactly the same size. And most people are going to leave a spouse who didn't even know how you were managing that thing, right?
Right.
And what's the statistic? 87% of women switch advisors when their husband dies anyway, so they're not even going to stay with the same person who was managing it, right? So there's no short life benefits. There's no long life benefits. Rough life, yeah, portfolio stocks is probably fine. During an emergency, you can access it as long as it didn't just drop 30%. Sick life is your broker or the third part, or the Fidelity or TD Ameritrade or whoever you have it housed with. Are they going to pay your long-term care bills? No. And then you finally move into the next life. It doesn't get bigger or transfer necessarily tax-free. So if I'm getting higher returns inside of life insurance policies and they do income well, or the annuity side of the business can do guaranteed income, if I can leave 3 or 4 times as much money to my spouse if I die, if companies like yours will let me accelerate the death benefit and use your money to pay for my long-term care expenses, and then when I do finally die or both of us pass away, it gets bigger and I can leave an estate to a charity or to children, what role would a stock, a bond, or a mutual fund ever have in my life?
And that's the thing is, until you get to excess of what your goal is, I think everything could be really nice. How many people have you ever invited over? Do you live in a 1-story or 2-story house?
2-story.
How many people have you ever invited to your house and says, come look at my foundation? Man, I've got the best foundation. And you walk around the house. No, you walk into the house and you see the first floor. If you know them very well, sometimes the second floor, that's where the bedrooms are. But the most important part of that house is that foundation, because if it cracks, that house worthless.
Yeah.
And so it's not sexy. It's not something that, hey, my Apple stock's gone up, whatever. Well, it was great until last week. It was, it's just not sexy, but it's so important as far as making sure those 5 lives are taken care of.
Yeah. So you and I agree on something. People should contribute up to the match. If you're giving money to a 401k or a 403b or some sort of employer-sponsored plan, you should be contributing money. If they're matching you 100 cents on the dollar, up to 3%, 5%, whatever it is, go ahead and do that. We agree on that, right?
Absolutely.
The free money covers a lot of increased taxes later on. It's every dollar over that. It's every dollar going into an IRA, because that's not matched, right? Or any type of sort of pre-tax strategy like that. How should someone make this decision? Should I pay tax, or should I pay tax now or pay it later?
Well, I'm going to step one step back, and this is something that we talked a little bit in the first podcast, but this is so important. Everybody says, Charlie, this is all well and good, but where do I find the money to fund this? I've got to have, I can't do it with $100 a month. And so the first place is definitely anything over the match on your 401k. If you're doing $300 over the match. That should be redirected to tax-free retirement.
Yep.
The second one is dead money. And I always say, what is dead money? Well, dead money is money that's not earning anything or being managed. What's the biggest dead money pool in America? A tax refund.
Yeah.
You get somebody that's 41 years old and they've got a $3,000 tax refund. They're excited. Why? Because they're going to have spending money. Well, what did Uncle Sam pay them on the interest to hold that for a year? Zero.
Right.
And you know why they didn't change it? Because they don't know how. It's a simple, easy change. You do it every day. So let's say we lower that tax refund to $600 and recapture $2,400. How much is that per month? It's $200 more per month, right?
Right.
And then the one thing that I am huge on is to retire successfully, you have to get out of consumer debt. If someone said, hey, Charlie, you need $5,000 for a new transmission, I get it. I'm going to loan you the money at, let's say 20%. I'm a nice guy. You think he's from New Jersey with the Sopranos. No, he's MasterCard, Visa, American Express, and Discover.
Right, exactly.
So you got $6,000 in consumer debt. You're paying $600 a month. You will never retire successfully. They want you to pay that minimum. So I want to do one of two things. I either want to borrow money from my 401k through a TEFRA loan, pay off that loan over a 60-month period, lower my payment from $600 down to $125 per month.
Mm-hmm.
That frees up $475 every single month that was going to MasterCard, Visa, and American Express. Now can go to tax-free retirement. Now, what do I do at the end of that loan? It's paid off. I paid it off either through the TEFRA loan, through my 401k. If I don't have a 401k, I call Discover and I say, hey, I want an 18-month 0% credit card. And for 17 months, I put that $600 into a tax-free retirement account. And then at the 17th month, I've taken that money plus the $200 from the tax refund and the $300 I was doing over the 403B match. I'm at $975 every single month. I put that in there. Now I can take a loan against my policy and pay that off, all at much lower interest rates, all below 3%.
Right.
And so I've done something. I've used arbitrage or leveraging. I've used somebody else's money or the ability to get to it, my money, borrowed it, paid off 20% interest rate, got it down to 3%. At the end of that 60 months, I'll have $65,000 to $70,000 in equity, and it didn't cost me a penny out of my take-home pay.
Yeah.
So don't let those brokers, and I know what you're going to say, the joker brokers who just take. Don't let them go and say that, well, you can't do this. You can, but you need a financial planner that's going to build a plan with you and for you. You have to sit down with those people and not just listen to a stock pitch.
Right.
You have to say, here's what I've got. Charlie, help me out with an overall plan, not just buying stocks, which is the last thing I need to do, not the first thing I need to do.
Yeah.
I didn't mean to get on my high horse, but that's a pet peeve of mine when people are in debt, people have dead money, and these brokers just say, hey, we want to sell you this stock because that's how they get paid. That's how they get a commission.
Right.
They're not doing financial planning. They're just order takers.
No, and let me give the listeners some ideas on, maybe some simple plans, some medium plans, and some advanced strategies. Simple plan, what you were just talking about is really, it's called finding the money or redirecting wealth transfers, right?
Right.
Find fees and money that you're paying unnecessarily or paying inefficiently and recapture it. Here's a little piece here, here's a piece here, a piece there. All of a sudden, it adds up. Most people, almost every American family, we've been able to find $500, $800 a month that can go into something like this, right?
Pretty easy.
Any situation, anytime you have 500 to 800 more going towards your retirement, especially if it's going to be tax-free, it's going to be helpful for you. So that's kind of example for streams of money, or, refinance a 15-year fixed mortgage back to a 30 and get that big savings and then put the difference away. It's just better going towards retirement anyway than jamming it inside of a house where you're not earning interest.
Right.
So those are simple. Another simple version would be, somebody gets an inheritance or they have a brokerage account that's not an IRA or a bunch of money sitting in the bank. Say you have $100,000 sitting in the bank because you don't have an emergency fund or whatever. Well, I've never seen anybody with an emergency of, $100,000, right? So you can drop that into a policy over 5 years, right? $20,000 a year for 5 years, slowly transfer from the bank over to the insurance. And then once it's inside the insurance by year 5, it's almost all of it's liquid in the emergency anyway, but now you're earning like stock rates of return, not bank rates of return, right? So
Correct.
simple ways to find the premium is find it monthly, or if you have a chunk of money sitting in a brokerage account or a bank account, you can move it over in 5 years. A little bit more complicated ways, if somebody's saying, well, where can I do this? What if they're, Jim, let's say, what if they're 55 and they do have 300-400 grand sitting in an IRA, but they're like, I do not want that to be taxed later. I want to pay taxes on this thing between now and 2025 when taxes are on sale. Can't that person do what's called a 72T? Can't they do a
Absolutely.
72T where they roll the money out of the IRA? Yes, they have to pay taxes, which is what we're trying. It's not your money anyway. You're sharing it with the IRS. You might as well get it out when it's on sale. But the 72T avoids the penalty before you're 59 and a half. You are allowed to take the money out. Perfect opportunity to systematically roll it out into an insurance policy, right?
Well, it's on sale till 2025. Why wouldn't you?
Why wouldn't you do it? And then here's my Charlie Jewett super duper solve everybody's problem in the whole world plan, right? This is the advanced strategy. I'm writing a book on it. Tell me if you follow this. Somebody paid off a house because they thought they're supposed to. That's this generation, right?
It's American way, right?
And they have a whole bunch of money in IRAs and 401ks, which is going to be taxable. Plus, it's going to drive up what's called provisional income, right? So then they're going to pay tax on their Social Security. I'm on board, right?
Absolutely.
No mortgage, no deductions, bunch of taxable income on top of pensions and Social Security allows the IRS to tax your Social Security. Now they're hearing this talk about tax-free income. They're going, oh my gosh, how do I do that, right? Tell me if you follow this. They sell that house, buy the one across the street, get it with a mortgage. If they're a veteran, they can do 100% financing. If they're like the rest of us, they can do 80%, right? Purposefully acquire a new house, so you have what's called acquisition indebtedness. It creates tax-deductible mortgage payments. So say they sell a house for $500,000. They put 20% down on the next house. They have a $400,000 mortgage. Do we agree?
Yes.
But they also have $400,000 of money from the proceeds of that home sitting in the bank after escrow. Now, how are we going to pay this higher mortgage? You work for an insurance company. Can't we put that IRA, the 401k, whatever taxable account they have, can't we put that into an annuity that gives a guaranteed payment for the rest of their life? Like no matter what happens in the market, you're getting $25,000 a year, $36,000 a year, whatever it is. It's guaranteed, right?
Absolutely.
If you set that IRA or 401k up to pay that new mortgage with a tax-deductible payment that you did not have before, and you pay it with the taxable distributions from the 401k and the IRA, I don't do taxes anymore out of my office, so you can go talk to your CPA, but on every tax return I've ever seen, that money's coming out of the IRA and 401k with absolutely no taxes. They're keeping every penny of it, and it's going towards that new mortgage, which guess what they're doing? They're renting the $400,000 of free and clear non-IRA money. Guess where that goes? That goes into a tax-free insurance policy. All of a sudden, we just solved almost every problem they have. And plus, your wife gets a new home, so she'll love us.
Well, and it's doing what you just said. For the people that are sitting out there saying, how could I do this? Here's my situation. There's tools that you use, just like Charlie said, for almost every situation.
Yeah. I mean, it's always, there's not everybody can be in a 0% tax bracket because some of you are too blessed. What do I mean by that? If you have a pension, if you have some form of pension where you're making $3,000, $4,000, $5,000 a year, we're never going to get you in a 0% tax bracket because it's not your choice. It's not like you have an IRA and you can choose to pay taxes and get it over with and switch to Roth. You just have somebody giving you too much money. It's because some of it's going to be taxable, right? But a lot of people can be in a 0% tax bracket. Everybody that I've met after doing over 1,000 of these can typically pay less taxes, can benefit in some way, right?
Well, I always say you can't do tax planning in the rearview mirror. You can only do it from this day forward.
Exactly.
What you've done in the past, whether it be in a 401k, a pension, it's hard to unwind unless you're doing the IRA rescue, but you're still going to pay your taxes. The difference is you're at the lowest tax bracket in the history of the United States, and for sure your listener's lifetime. Why not pay tax now versus later when you know they're going to go up in 2025?
It's a great point. It's absolutely a great point. Taxes are on sale. So who should email or call in and ask for help, or who can we help? One, easy. Anybody who's contributing to a 401k or 403b or anything like that where you're not being matched. A lot of those matches went away when companies got in trouble in 2008, 2009. So if you're putting in money that's unmatched or putting in more than the match, definitely get in touch. Charlie at JewettWealth.com, CharLie at JewettWealth.com. The other group of people would be, people like I mentioned, have a bunch of money sitting in the bank and want to get it earned in stock-like returns instead of just sitting there doing nothing. How about people that currently own life insurance policies? Isn't every life insurance policy that exists, I mean, wouldn't this be a dream, Jim, if we were allowed to review every policy in the country and say keep it or transfer it? But doesn't every policy that exists, basically, it's like refinancing a mortgage. You look at it and say, what do you have? What company? What type of expenses? What type of earnings? Versus what else could you possibly be in? What are the new modern policies? And should you stay or should you go? And guess what? The IRS even makes a way for you to transfer all your cash value from one policy to another and not pay any taxes, right?
Charlie, we had one the other day, and a guy called me and said, I just can't get this policy that I'm doing. It's $1 million policy on one of my clients. It's 5 years old, so I know they should be paying more, but they're paying less. They don't have living benefits, but this one has all the living benefits. How can it actually be less? Am I doing something wrong? I said, well, no, because life expectancy, the actuarial charts had been redone.
Yeah.
And for companies that hadn't redone them yet, they're at the old higher rates with no living benefits. And so because of that change nationally, a lot of people just by looking or reviewing their policy could pay less, get more benefits, and you scratch your head, but that's the situation we're in and this time and place in the insurance market.
Exactly. And there's sort of a motto out there that you never replace a life insurance policy or you don't replace it in the early years. And that's technically true if it was set up perfectly in the first place, right?
Correct.
But the problem is that's less than 1 or 2% of the policies that I've seen. It's set up in a way right now. If you own, I'm pretty confident to say, if you own a life insurance policy that has any cash value at all, it's whole life or universal life, it's set up with way too much death benefit. The fees are too high and the earnings are too low. And let's say we refinance that thing. You leave one company and you go to another company, you pay a surrender penalty. Okay, so you're down $2,000, $3,000, $4,000 or whatever it is. It's exactly the way we used to refinance houses. We'd pay $3,000 or $4,000 in title and escrow to just get our rate down because it saved us $500 or $600 a month. And over 8 months, we made it back, right?
And you roll it into the plan.
Yes, you just roll it into the plan and say, okay, we're going backwards for a very short temporary time to then make it up. How long are you going to keep a life insurance policy? The rest of your life. It's
till the day you die.
As long-term as you could possibly get, right?
Correct.
And I'm telling you, this. National Life Group is who taught me this. The how do you reduce commissions to give people better returns and all that. I'm telling you how a policy is designed. The expertise, the artistry of the designer, the life insurance agent like me, makes all the difference in the world. We can raise your rate of return 1 or 2% per year forever, which in compounding is huge, right?
Absolutely.
And I don't know if you've heard me on my show challenging, the coward challenge and challenging every advisor in the country to meet me on TV or anybody to send a life insurance policy and I'll beat it. But that's why. So if you own a life insurance policy, for sure, get in touch. Charlie@jewettwealth.com, CHARLIE@JEWETT wealth.com. If you're contributing to a 401k or an IRA, get in touch. If you have a house that's owned free and clear, which is going to cause some major tax problems if you're using IRAs and 401ks in the future, get in touch. Any other groups? Well, the high income earners. We'll talk about this next week, but the high income earners, Jim, in this world can do better than pretty much anybody. And we're talking if you can afford to put away, $20,000, $30,000 a year and up?
Well, yeah, and we talked about earlier, someone that's making, $250,000, $300,000 a year can't save 18.5 into a 401k or any type of retirement plan and retire with 100% of their income. It's just not going to happen.
Right.
So we want to use something called arbitrage or leverage. That's what every financial institution in America does. They try to earn 2%. They don't want to do it on hundred thousands. They want to do it on billions. But we can do that using premium finance for everyday people, for middle-income Americans that are making $200,000, $300,000 a year, and actually get everything that we talked about today free. Actually have someone else pay for it. That's what we want to talk about on our next podcast.
And I'm going to say it this way for people to understand. Both Jim and I said adamantly earlier that if you have, $18,000 a year going into an account and the company's going to match you, if your employer is going to turn your 18 into 18, right? All day long, that's worth it. Jim, what we're going to teach next week is a 3 times match. that if you're putting in, let me do easier math for me. If you're putting in 20,000, they're going to turn into 80,000. I'm sorry, 4 times match. So they're going to, whatever you put in, they're going to match it 3 times. So you have 4 times the premium, right?
That's correct.
That's what we're going to teach. And so we'll come back next week and do that. Anything else you want to say on tax-free income? Well, let's just do this. Everybody has this question. Can the government change their mind and say, oh my God, all of a sudden now these are taxed? I would give you my answer. They can always do that on anything. They could just say, okay, I know you contributed to a Roth for 40 years, but we're going to change our mind, right? So could they? Yes. Would they? The insurance lobby's fairly large, right?
Well, not only that, and too many of those people that make the laws own these policies. It's not going to happen. There's just too many. If it ever happened, it would be from this day going forward. The people that actually own these policies would be grandfathered.
Right. So get in as fast as possible is really the rule, right?
2025, it's staring us in the face.
So taxes are on sale between now and 2025. Now's the time to convert IRAs to Roth IRA, to stop postponing tax. Don't be overfunding 401ks, 403bs, and IRAs, but to redirect all of those premiums to cash value life insurance or tax-free strategies. It does need to be set up the right way, so get in touch. We'll show you how to do that. Charlie, CHARLIE, at jewett.wealth.com, JEWETT Wealth. And then, Jim, we're going to come back next week and teach people how to leverage, how to, if you do have money, how to get, $4 going in for every dollar that you have, which is awesome, right?
Correct.
And also, let me give you guys a phone number if you just want to skip the email and just call in, 888-285-2268, 888-285-2268. Just let me know that you heard the talk with Jim and you think he's the smartest guy in the world.
Hey, have a happy Thanksgiving to everyone.
Absolutely. Thanks, Jim. We'll come back next week. But this has been How to Retire with Tax-Free Income with Jim Carroll, Part 2. One more part to come. We do this because we think you people are the best.
But that's all, folks.